When you decide it is time to start building wealth, it is incredibly tempting to jump straight into the stock market. You see the projected profits and hear the experiences of others, and it makes you want to get started immediately. But skipping the preparatory work creates a massive vulnerability. If a sudden car repair or medical bill forces you to sell your stocks during a market downturn, you aren't just losing cash, you are resetting your entire financial timeline back to zero. Before you buy a single share, you need to count the cost. Today, we are going to walk through a personalized pre-investment readiness audit to definitively determine if you have the green light to proceed. Grab a pen, some paper, a calculator, and your recent financial statements. Keep in mind, this tutorial is not financial advice. This is strictly opinion based on experience, and you invest at your own risk. Building this physical checklist is the only way to separate your emotional excitement about the market from the raw mathematics of your actual financial readiness. Step 1 of our audit starts right at the top of your page. We need to define your emergency fund. Write down your expected monthly income. Now multiply that number by 6 and write down the total. That final number is your target safety net. This specific money must never be put at risk. Do not put these funds into the stock market or any other volatile asset. Instead, this safety net must sit in a highly liquid account. It should be readily available to you, like a high-yield savings account or a money market account, where it can quietly earn interest. When you see that cash sitting in your savings, you will be tempted to use it for an attractive stock trade. You have to ignore that urge. This money serves as a protective shield, not your trading capital. By fully funding this 6-month reserve first, you ensure that if a sudden life emergency happens, you will never have to sell off your actual investments at a loss just to survive. Now let's move down your page to step 2. We are going to audit your current liabilities. Pull up your recent credit card statements or consumer loan documents. Check the interest rates you are currently paying and identify any balance that carries a rate of 15% or higher. If you find rates at or above that level, your immediate mandate is to redirect all of your free cash towards zeroing out those specific balances. This split screen compares the uncertainty of the stock market on the left with your credit card debt on the right. While market returns are unpredictable, the absolute drain of a 15% interest rate is guaranteed. Mathematically, paying off a balance that charges you 15% interest is exactly the same as achieving a guaranteed 15% return on an investment. Take that guaranteed 15% win right now. Do not risk your cash time to beat that percentage in the active market. Eradicating this high-interest debt plugs the holes in your financial bucket. It ensures you aren't bleeding cash faster than your future portfolio can grow. We have one final preparatory step on your audit before active retail investing can begin. Log into your employer's HR or benefits portal and locate your 401k settings. Find the exact percentage of your contributions that your company is willing to match. That match represents free money added directly to your compensation. Adjust your contribution slider so that you are depositing at least enough to capture that entire employer match. The employer match gives you an immediate 100% return on your contribution. When you combine that initial boost with 30 or 40 years of tax-free compounding, these individual accounts can realistically reach a 7-figure balance by the time you retire. A common mistake for new investors is leaving this employer match on the table because they want to use that cash for riskier, non-advantaged stock trades. Maximizing this match offers a straightforward path to wealth creation, and it requires absolutely zero active trading effort to secure. Now, look down at your completed physical checklist. You should see your specific savings target, your debt hit list, and your 401k confirmation right in front of you. This entire audit applies the logic of Dave Ramsey's baby steps approach. He teaches that building this unbreakable financial foundation is a strict requirement before you go all in on investing. Here is your verdict. If there are any unchecked boxes on your page, your only job is to go fix them. But if you have your emergency fund, zero high-interest debt, and your 401k match secured, you have the definitive green light to open a brokerage account. Completing this audit means your strategy is no longer a reaction to your current bank balance. You have built the structural foundation required to stay in the market long enough for the math to actually work.